stretch product is basically covered 3 to 1 by the value of Bitcoin. So that would suggest you have $800 billion worth of Bitcoins that you might be able to support 2.4 trillion of digital credit. We think over time that the public Bitcoin treasury companies can own roughly 10% of all of the outstanding Bitcoin, that will ever be mined. So, 2.1 million Bitcoins. I mean, they've put up, very strong Bitcoin per share growth, despite the fact that we've seen Bitcoin go down from 125 to 58, right? And yet still they've increased by 14, 15% year to date. If you think that like S&P inclusion, the S&P 500 that's going to be the catalyst that gets strategy working again, I don't think so. It's the other way around. S&P is not going to include MicroStrategy in the index until. Let me start, if I can, by talking a little bit about my journey to where we are today. I think it'll help set the stage. I came to this through traditional equity research rather than through Bitcoin, right? My background is very much TradFi, public company analysis, valuation, capital allocation, capital markets. I was not an early Bitcoin adopter, and I certainly wasn't a Bitcoin evangelist. If anything, I started out as a Bitcoin skeptic. And what happened was in the fall of 2022, I was asked to look at a little company then known as MicroStrategy. I know you all know it well now. At the time, I thought I was analyzing a software company with an unusual treasury policy. And over time, I came to believe that that was not the right framework. And what I was really watching was the emergence of a new type of public company. As we spent more time analyzing the space, one of the conclusions that we reached was that digital asset treasuries may deserve to be viewed as their own investable category. So in our big April piece, we attempted to formalize a framework for evaluating those companies, whether they're built around Bitcoin, Ethereum, or any other digital asset. And the key insight is that investors increasingly have choices. They can own digital assets directly. They can own ETFs. Or they can own actively managed public companies that attempt to increase digital assets per share over time. And that per share concept is really the key. When we evaluate a Bitcoin treasury company today, the first question is not how much Bitcoin does it own. Obviously, that's important, but we think the more important question is whether the company can increase Bitcoin per fully diluted share over time. And the reason we think is straightforward. If I buy one Bitcoin and hold it, I own one Bitcoin. A well-run treasury company is trying to give me ownership of a growing amount of Bitcoin over time. And if it can do that consistently, value can be created even during periods when Bitcoin itself isn't doing much, like the period we're in right now. So when we evaluate these companies, we're looking at things like Bitcoin per share growth. We're looking for cost of capital, access to capital, balance sheet resilience, liquidity, management credibility, the company's ability to continue executing through different market cycles. And that's also why I think investors sometimes spend too much time debating whether these companies should or should not trade at premiums to NAV. In our view, the more interesting question is not whether a premium should exist, it's which companies deserve one. If a company is consistently compounding Bitcoin per share and has a structural advantage that passive investors or passive ownership doesn't have, it's reasonable to ask whether that deserves a valuation premium. And that's really what attracted me to strategy in the first place. It wasn't just a company buying Bitcoin. It was a company using public capital markets in increasingly sophisticated ways to compound Bitcoin ownership per share. And that, to me, remains the most interesting story in the space.
Yeah, it's been really interesting to watch. Bitcoin per share kind of become this leading indicator. In the broader space, Lance. I guess at what point was there a moment when you realized that metric was everything? And then how do you model kind of like the BTC gain that a company like Strategy can expect to create over longer to medium timeframes?
Well, look, I mean, first of all, I wouldn't say that it's the only metric that we look at, right? So, and by the way, right, there's a lot of people now that are saying like, hey, well, you really can't look at Bitcoin per share. Bitcoin per share is meaningless because it doesn't take into account the leverage that's embedded in the model. And, look, again, I come from a TradFi background, and they make a decent point. There are companies that are so levered that metrics like free cash flow per share become meaningless because the equity shareholder is never going to see a dime of that cash flow because all of the cash flow is going to be needed to pay down debt. Now, in the case of strategy, however, we think that that is far from the case. We think that this is a company that has built a very flexible, relatively conservative balance sheet. And frankly, most of the obligations, I'm not going to call it debt because most of them are preferred instruments, but most of the obligations that they have no maturity. They will never need to be paid back, right? They think about that for a second. They've attracted over $15 billion of capital with a promise to never repay, right? They will pay the dividends, but they will never repay that $15.5 billion. So we think that yes, Bitcoin per share is the key metric. It's not the only metric, but it is the key metric in terms of how we model it. Yeah, very carefully. I mean, I think it certainly is not for the faint of heart. But look, we look at not to be trite, but the track record of the company's ability to have generated Bitcoin per share growth over the past X number of years is a really good starting place, right? So, it's much easier for me to get confidence in a company like Strategy when I can look and I can see that, okay, since they started in the fall of 2020, they've been able to increase Bitcoin per share year in, year out, whether Bitcoin was up or down, right? So in 2022, when they spent at least, I don't know, most of the back half of that year, they spent with an MNAV below one, right? They weren't trading at a premium to Bitcoin, they were trading at a discount. And yet they still managed to increase the amount of Bitcoin they held on a per share basis, right? So far through this year, they've put up, very strong Bitcoin per share growth, despite the fact that we've seen Bitcoin go down from 125 to 58, right? And yet still they've increased by 14, 15% year to date. So um, so the ability to having done it before matters a lot. And of course, that's rooted in things like access to capital. That's rooted in things like, their cost of capital. Do they have a cost of capital advantage? Do they have a management team that has conviction and that understands that Bitcoin is going to be cyclical, that the volatility of Bitcoin is not a bug? It's part of the proposition. And so those are all things that we look at when we attempt to build out these forecasts.
Yeah, that's really interesting, Lance. And you said you've been covering strategy since 2022, and most of our viewers are pretty familiar, with uh, the iterations the management team at Strategy have made, from funding a lot of the Bitcoin acquisitions initially through cash flows, but of course they moved to a convertible debt model, issuing convertible notes at with low repayment terms that were convertible for equity. And then last year was kind of the iPhone moment, as Michael Saylor and the team have called it, when they rolled out STRF, STRC, all the digital credit products, so called, these preferred equities. And they're taking a really different approach from my vantage point, to preferred equities than anyone has ever done. Like you said, crucially, they're raising money that never has to be paid back, other than the ongoing dividends. So, I mean, like, how much of a game changer was that rotation to digital credit? Obviously, we've seen the wild success through this drawdown. Like you said, Bitcoin's down over 50% from its all-time highs. Yet, there were moments this year when Strategy was able to raise $2 billion in preferred equity raises. So, yeah, how much of a game changer was that? And what does that look like moving forward? And how do you expect, I guess, that digital credit model to evolve in a Bitcoin bull market?
Well, let me start with where we are today, and then we'll get to where I hope we wind up going. And this, I think, is the most important part of the conversation, right? If Bitcoin treasury equity was the first major innovation, I think digital credit may prove to be the second. But I'd sharpen that even further. The most interesting thing about Stretch, in my opinion, is not simply the dividend. It is that Strategy may be demonstrating how Bitcoin heavy balance sheets can monetize credit demand and convert that demand into incremental Bitcoin per share growth. This is the framework that we've laid out in some of our recent research, where we've described strategy as evolving into a two-layer model. Stretch monetizes credit demand into stable yield, while MSTR, the underlying common stock, converts that capital into incremental Bitcoin per share growth or Bitcoin yield. So I think about Stretch as a funding engine, not merely a funding vehicle. It attracts a different kind of investor from the common stock. The common stock is a high volatility equity instrument tied to Bitcoin accumulation and capital markets execution. Stretch is designed as a yield oriented, comparatively lower volatility instrument that can bring in income focused capital that might not otherwise be in the crypto ecosystem. The flywheel is relatively straightforward. Stretch attracts yield-oriented capital. That capital funds incremental Bitcoin purchases. Bitcoin per share increases. The economics of the common equity improve. If the market rewards that with a stronger premium, and increasingly, to get to your question about what this looks like in a bull market, then the lower cost of capital enables the company to potentially continue the cycle. And so Stretch is not merely a funding tool, right? But it's really a key determinant, we think, of whether MicroStrategy or strategy can structurally outperform Bitcoin over time. And I think that the durability of Strategy's model may ultimately depend on continued Stretch demand, as well as stable access to capital markets and management discipline and the other things that I mentioned earlier. Now, I want to be careful not to overstate where we are. This is still early, in my opinion. And Michael Saylor can talk about how Bitcoin is one, and I take his point. It's certainly established itself as the dominant source of digital capital, but Stretch does not by itself prove that digital credit becomes a massive market. It does prove that the concept is serious enough to attract meaningful investor attention, and the emergence of other preferred instruments, I think, begins to test whether demand is transferable beyond a single issuer. And this is important. And it explains why I think the preferred complex matters, right? Not every investor wants the MSTR common volatility. Not every investor wants direct Bitcoin exposure, but many investors understand income. They're looking for yield. They want liquidity. They understand preferred equity and credit-like instruments. And so Stretch is taking this balance sheet and packaging it in a way that makes sense to them. And so, I think my answer is, in short, digital credit may be the second innovation, but the deeper point is that strategy is trying to build a capital stack around Bitcoin, and Stretch is a funding engine for that capital stack.
Yeah, really interesting points. I think, there's a parallel. So when the Bitcoin ETFs launched in 2024, that was, you know, showing that there was huge pent up demand, for a product like a Bitcoin-backed ETF through an institutional wrapper that was, stamped by BlackRock in trading in U.S. equity markets in a well-regulated environment. I think a takeaway from what you said is that there was some pent-up demand for Bitcoin exposure, with the volatility stripped down, right? And that's what we're seeing with the monthly, now semi-monthly dividends being paid on STRC. And the broader question, like you said, is how does strategy tap into the next iteration of demand? How do they tap into the income investor who's looking for income, and compare the digital credit model alongside traditional income vehicles? And is that Michael Saylor being out there, being a salesman? Is that how he converts people? Like, what's the path, I guess, to bring more of that capital in to the strategy equity ecosystem, and how big realistically is that market?
Well, Tyler, I mean, I think you put it really well, right? I mean, what stands out to me is the adaptability and the breadth of this toolkit, right? And so strategy began with a fairly straightforward treasury strategy. But over time, right, it has added multiple layers of capital markets flexibility. So it started with just the common, then it added not preferred but convertible securities. Then it added not just one flavor of preferred instrument, but senior preferred, and then junior preferred, and then convertible preferred, and then variable rate preferred. And now they've sort of augmented that with their more formal digital credit capital framework. The way I think about it is that strategy is increasingly managing its capital structure the way a sophisticated financial institution might manage liabilities. This does not mean it's a bank. It means that the company is thinking about funding sources, investor constituencies, fixed charges, liquidity support, reserve management, and capital allocation across the stack. We've written about this a fair amount. Strategy introduced a board approved USD reserve policy, revised stretch dividend approach, repurchase authorizations, and a formal yet flexible BTC monetization program. Now, our view is that these steps largely formalized elements that had already been embedded in our thesis. So we don't think that it was like a huge shift. In fact, I don't think it was any shift in direction, but it did serve to formally codify and put some guardrails around the types of things that they've been speaking with investors about for some period of time. And I think this matters because each part of the capital structure that exists today and going forward, because to your point, I do think that there are additional pockets of capital that have yet to be tapped and that ultimately can be over time. But the model only works if you respect that each of these pockets is a different, although related, investor constituency. Equity investors want long-term Bitcoin per share growth. Preferred investors want confidence in dividend durability and liquidity. Convert investors think about optionality, on and on. These are related constituencies, but they're not identical. So the capital structure has to do several things at once. And strategy, Michael Saylor, they make it look easy, but it's not, right? It has to support Bitcoin accumulation, but it also has to preserve flexibility. It also has to maintain confidence across the stack. It has to, the equity doesn't work if people don't, if the preferred guys aren't happy, right? And the preferred isn't working if the equity isn't working. So, ideally, the company needs to be able to avoid near-term liquidity stress, and this allows the company to respond to market signals rather than being locked into one funding channel. And the last piece of this, if I may, is one of Saylor's real advantages. Strategy has shown a willingness to use different securities depending on market conditions, right? When the equity is attractive, they issue shares. When converts were their best source of capital, they issued a lot of converts. When preferred demand is strong, the company can build that market and so on and so forth. And look, I know as an example, the company doesn't have any straight debt today, but that's only because they don't perceive that there is a really attractive source of straight debt at their disposal. Even convertible bonds, which the company has said very clearly that they're looking to retire all of their convertible bonds and they have no interest in it. The minute that a convertible bond gives them the best access to capital, they will go out and issue a convertible bond again. That's my opinion. And I think that is not flip-flopping. That is them taking advantage of what the capital markets are offering them at any given point in time.
Yeah, I think that's a really good point to digest, and I think any investor, any analyst, anybody monitoring the space has to look at, Michael Saylor is this whole balance sheet strategy is a capital markets play, and he's going to, find ways to, I guess, raise money in the ways that is most accretive to shareholders long term. So yeah, I think flexibility, optionality, like you said, have been really keywords in the evolution of strategy this year to date, certainly. And it's tough. It's probably tough sitting in Michael Saylor's chair, trying to keep every investor happy. But like I do think the management team is so crucial in this case, that they've got the long term vision of providing value and being able to outperform Bitcoin and becoming one of these companies, the leader, that is trying to outperform Bitcoin long term. So when I think about like um, some of the updates or changes that strategy has made this year, or iterations, reiterations, like you said, Lance. What's your take, I guess, on the updating of that the board's going to keep at least 12 months of like a USD reserve to cover their dividends. Right now, as I look at strategies metrics, it looks like they have about 22 months worth of dividend coverage. Do you is there a right amount to you? How how should investors um, think about the cash runway in relation to dividends? Do they look a lot different in a bear market versus a bull market, for instance? It's official. The Bitcoin Treasuries conference lineup just dropped. Grant Cardone, Adam Back, Eric Weiss, the man who introduced Sailor to Bitcoin in the first place. Plus, the CEO is actually running the treasury companies, and the macro voices calling out where the institutional capital goes next. 10 confirmed speakers, one closed-door room, September 28th in New York at 2nd. Save 10% on tickets today by using the code SECOND. Reserve your seat by scanning the QR code on the screen or visit bitcointreasuries.net/conference. We'll see you in New York.
Yeah, well, look, I mean, so let's start with what their board has approved, which is a hard, minimum of 1 year. That's only 12 months, as you pointed out, right? They're well beyond that. They're at 22 months, so they're already almost double their sort of minimum threshold. I think they're going to continue to build that. I think that they're going to settle in somewhere between 24 and 36 months. And, I think that they're going to issue more shares. You saw, their release this past Monday, right, where they didn't buy any Bitcoin. They just went out and issued some stock to pad that reserve. It's at 3.25 billion right now, which, that's the 22 months. I think they're going to continue to build that. And I think that is ultimately, I view that as being very much in the long-term interests and medium-term, in fact, interests of the MSTR common shareholders. So look, the bears can say, oh my gosh, they're diluting, the common, they're selling common, they're not buying Bitcoin, they're, you know, true, but it's a means to an end. And when to the extent, I should say, because we don't know that this is going to work, but I understand what they're trying to do. To the extent that the company is successful in restoring confidence in Stretch and getting Stretch back to par, then at that point, then Stretch becomes, then they regain access to that engine, and I think that that's a really big deal. Can I actually just go back? You'd asked earlier about addressable market, and
Yeah,
I
yeah,
did want to
please.
just say that, yeah, well, the size of the addressable market, and I think I want to be careful about, throwing out specific numbers, on this format. But I will say I can point to our published research where we've suggested that we think over time that the public Bitcoin treasury companies can own roughly 10% of all of the outstanding Bitcoin, though, well, that will ever be mined. So, 2.1 million Bitcoins, right? And I think that we put in the report that by the time they own that, if you looked at our price targets, which maybe has changed a little bit since then, but we were talking about like that being worth $800 billion. So, so imagine a group of companies that own $800 billion worth of Bitcoin. Now, that's not the addressable market. That's just the amount of Bitcoin that they own. Now we ask ourselves, well, does the equity trade, at one times that? Does the equity trade at a premium to that? What about all the credit products, right? Can we, right now, as an example, right, the stretch product is basically covered 3 to 1 by the value of its Bitcoin. So that would suggest, if you have $800 billion worth of Bitcoins, that you might be able to support 2.4 trillion, excuse me, trillion with a T of digital credit. So I'm not saying that we're going to ever see that because the jury is still out, right? But one of the things that's really important, and we haven't really talked about Strive or SATA yet, but I think that those are really important. And you know, it's interesting. I think a lot of people when they think about Strive and SATA, they think, oh my gosh, this is like competition. for strategy and stretch, and oh, there's strive is, stretch rather is trading in the, wherever it's trading, and SATA is trading closer to par. And so are we seeing this, rotation of capital from one company to the next? These are all legitimate questions, but in a way, I think they're missing the forest from the trees. I think what's really much more important is that you've got another company in the market that is, that is helping to develop the marketplace. The bigger takeaway in my mind is that the preferred concept is no longer exclusively strategy specific. And this matters because the market, this ties back into the question of how big this market ultimately gets. The market now gets to test whether Bitcoin backed preferred equity can become a category rather than a single issuer structure. Strategy was the first. It certainly remains the center of gravity. I don't really care where it's trading relative to SATA. That's where the market cap is, right? There's 15, and there's they've got 15.5 billion of total prefs. They've got about 10 billion of stretch, right? So even at a discount, that's a lot of value. But when another issuer comes to market with a Bitcoin linked preferred instrument, the question becomes, can demand for this type of security transfer across issuers? It's a very important test, in my opinion. If investors are willing to compare Stretch and SATA and future securities across issuer quality, yield, liquidity, so on and so forth, then you're watching the beginnings of a market structure. So I think that's really important. And I would go further to say that now we're seeing the derivatives on Stretch and SATA, and I find this fascinating, right? There are products now that you can buy that provide an index-like exposure to both Stretch and SATA. And then even cooler than that, there are products, and I'm sure you and your audience are probably well aware of this, right? There are products that are attempting to parse the volatility even further, like a senior tranche paying perhaps 8% with near zero volatility, offset by a junior tranche that's admittedly more volatile than Stretch overall, but also pays a higher dividend rate than Stretch. So look, whether these products take off, in my opinion, remains to be seen, but it is an interesting development and something we're going to continue to watch closely.
Yeah, I think there have been a lot of interesting developments, and the early signals, I guess, on market structure around this strategy and in different issuers have been bullish from my seat. And we'll talk a little bit more about Strive and SATA in a second. I've got a couple quick follow-ups, Lance. So you talked about public, Bitcoin treasury companies, companies treasuring Bitcoin. 10% of the total Bitcoin supply is a figure that you mentioned. Is there a concentration risk? I hear a lot of feedback, particularly through X. Maybe some of it's not well reasoned and it's reactionary, but is there really a concentration risk to one company or just maybe a few holders of an asset holding that much Bitcoin on their balance sheets? I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC-regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-treasury to connect with their team.
You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
So I'll tell you the way that I think about it. I think it's a very interesting debate, and I'm interested in other people's points of view on this. But I think that while of course, there's always a risk. I mean, if you told me that, hey, we've got this new form of digital capital and one guy owns 100% of it, then that obviously doesn't work, right? I think though you can have someone owning more than, 1% of it, right? So the real question is not whether concentration could theoretically be a problem. It's how much is too much. And again, I think a big part of that is it's a qualitative assessment. But in my opinion, if you've got, I mean, look at the public equity market structure as an example, right? There are so many companies that trade actively where the insiders or the public, where the insiders own more than 10%. The public float is a lot less than 90%. Sometimes the public float's less than 50%, and the securities trade just fine, right? So, look, we don't know. My best guess is that if from a market tolerance standpoint, if we're right about Bitcoin ultimately becoming increasingly accepted as digital capital, then the market could certainly tolerate a lot greater concentration than 10%, right?
Yeah,
Arguably, it could 30 or 40%, right? And it would
sure,
still be
sure.
perfectly viable. If Bitcoin, doesn't really ever meet that threshold, then it doesn't really matter, quite frankly, right? So I think we have to assume that the reason that we want to have exposure to Bitcoin in the first place is because we believe it is increasingly going to be viewed as digital capital. So in that model, that argues for a 10% concentration of ownership of Bitcoins should not matter. Now, very different question on, well, what about the concentration of mining, concentration of nodes, concentration, on that side of the business. I think that that's really where arguably, and I don't consider myself an expert on the underlying coding and cryptography, computer science of it all. But I would imagine that's really where I think we have to worry a little bit more about concentration. It's not who owns the Bitcoin, it's who controls the vote on whether or not we can change the code.
Yeah. No, no, really, really great points, I think, there, Lance, and something to consider. It's we talk when thinking about strategy in other companies like this. It's like, okay, what's Bitcoin doing, and how does that affect, how the equities are trading? But at the same time, you can flip that to the inverse. It's what is strategy doing for Bitcoin's adoption overall in the broader marketplace? And I think, the work that Saylor's been doing has pay dividends. Like I said, the institutionalization of Bitcoin as an asset on more institutional balance sheets of products out there, derivative products of Bitcoin, like IBIT and others in the marketplace. I think we'll see the demand continue to grow, but that's the ongoing thesis and the big question, certainly. Talking again, we'll wrap up kind of this talk on strategy right here. But when we're thinking about creditworthiness of strategy and STRC. As you mentioned, it's been tested a little bit in price. The effective yield on STRC is about 200 bips above the fixed yield that is when it's trading at its $100 par level. So it's about 14% as we're recording right now. The effective yield. What do you think's driving that overall? Is this like a temporary sentiment thing where the marketplace is I guess just bearish on Bitcoin's price dropping down? Is this a signal that investors didn't digest maybe the retiring of strategies, some of their convertible notes a couple months ago, them selling a little bit of Bitcoin recently to fund dividends? Like, why do you think that dislocation's happening? And what's it going to take for STRC to return to par?
I think that there's a lot of factors. I certainly don't think, I think all of the things that you mentioned are playing a role. I think that personally, my view is that even if Bitcoin were to stay at, 64,000 or whatever it's at today, even if it were to stay there for the next 6 months, my suspicion is that Stretch is trading at par within, by the end of that period, certainly. I don't know if it's going to be trading at par in 2 weeks. But it might be trading. 2 months seems reasonable to me, but who knows? But maybe it takes longer. Maybe it takes 6 months. But it's not going to just happen in a vacuum. The reason it's going to happen is because investors are seeing that the company is adding to this preferred dividend reserve, the USD reserve, right? We talked about it. It's gone from 1 year to 22 months, and I think it's going to wind up going north of 24 months certainly. And so I think they're going to find. I don't expect the dividend rate to increase further. That I think we're done on. I think at this point it's more about seeing that the bottom isn't dropping out of Bitcoin, right? So even if they didn't add to the reserve, I think 6 months from now, if the market sees that like, hey, Bitcoin's been okay, it's been bouncing around between 60 and 70,000. Okay, so my coverage is about 3 times. I think that they start to feel more comfortable, all else equal. I think then if you layer in that along the way, we've also been adding to that reserve, and now we've got 3 years maybe, or 2.5 years of dividends pre-funded. I think that also helps. And then, certainly last but not least, right? I mean, if Bitcoin does resume its upward trajectory, then we could rip back to par much more quickly. So Bitcoin recovery isn't necessary, and that's the one thing that the company can't control. But I think that they can do a lot on their end to sort of improve that pricing. But in answer to your question, why did it happen? I mean, yeah, I think there was also one thing I don't think you mentioned was there was a lot of leverage in the system, right? I think a lot of people, when they were first pitched Stretch, not by me, not by the company, but I think there were people who were likening it to a stable coin. And they were sort of almost saying like, hey, you buy this, it stays at par, and you get your dividend, and that's that, right? And that was, and the company was, very vocal about targeting par, and hey, here are the things that we're going to do. But there was never an implicit promise made that it was going to be. It's not a stable coin. It wasn't designed to be a stable coin. It's designed to offer investors exposure to Bitcoin with much less volatility than the underlying or the common stock, and it has done that. But I think there was a lot of misunderstanding. I think that those folks are largely now out. And so I think we've now kind of established a new kind of, baseline. So I think, but that's I think that levered factor and that lack of perhaps, I don't want to say sophistication, but maybe there was some misunderstanding or misconception around what the instrument was designed to do and what it could in theory do.
That's a really great point, Lance. I almost think, yeah, that if I had to place a bet, that was like the likeliest reason that Stretch got tested so hard was the leverage that was built up. And those, leverage built up on Bitcoin adjacent products, crypto adjacent product. That's something that's happened throughout crypto's broader history. We've seen that time and time again happen. So, yeah, no surprise there. And yeah, it'll be interesting to see, how quickly this recovery does take with some of that leverage seemingly flushed out. I'd like to talk Strive and SATA. I released a podcast episode just yesterday as we're recording here with Matt Cole, and he always gets me really excited about what the team's doing there. Like you said, they saw what Saylor was doing, and they're like they were able to learn from some of the things he did, and I guess mimic his strategy in some ways and diverge in other ways. And I think the two companies have had this symbiotic relationship, which you don't often see among companies that otherwise would be considered competitors, but they learn from each other. They network and just use the things that the other company is doing to improve. I think their own sentiment and the way they operate their company. But yeah, Matt Cole painted a vision when I was talking with him that he's like, we're not going to catch strategy in magnitude of Bitcoin on our balance sheet, but we want to be the fastest growing company. If the Bitcoin thesis, again, that underpins all of this, if the Bitcoin thesis plays out as we think, as premier digital capital, Strive has a chance to really outperform that, and they've they've taken a completely different model or iterated on Saylor's model with having now no debt on their balance sheet in the traditional sense, and their only leverage or amplification, as they call it, is from their single preferred equity in SATA. So, and interestingly, SATA is the first equity in market history to pay daily dividends on an equity, which was, you know, so cool to see the team there execute on that. What are your takeaways from, how I guess SATA has held up in the vision from Strive and the management team there?
Well, first of all, we have a constructive outlook on Strive. We have a buy rating and a $28 price target on the common stock. And we like SATA as well. We have a buy rating on that as well. I would say that, on the daily dividend, I'd frame it as an investor design feature. Income investors care about payment cadence, liquidity, yield visibility, and how a security fits into the portfolio. A more frequent dividend may make the instrument feel more usable to certain investors, but I would not overstate it as the whole story. I think, yeah, and yes, it's cool that they did it. It's a neat innovation. The bigger story is that issuers are experimenting with how to design Bitcoin-backed income instruments for different investor preferences. And that fits with our broader DAT framework, right? So in our April report, we wrote that well-run PBTCs may help facilitate Bitcoin's transition by designing and issuing innovative Bitcoin-backed securities that funnel investment from discrete pockets of capital that vary by risk tolerance, currency exposure, and other constraints. SATA is interesting in that context because it helps test whether those investor pockets exist beyond strategy. I think that the point that you made about I think you said that Matt said, look, we know we're never going to be the biggest, but we think we can grow the fastest. I think that is a very interesting point. And when we are looking for which companies to cover and which companies we think offer the most value to investors, right? It's not how much Bitcoin they own. It's how do we gauge their ability to increase Bitcoin per share? Because, and look, part of that is related to your scale, right? If you own, 850,000 Bitcoins, you're probably going to be able to do things from a cost of capital perspective that someone that owns 850 Bitcoins can't do, right? So there is, I'm not saying that size doesn't matter, right? But we think that there's a sweet spot, right? We think that you do need to have a certain scale, but you also, if you can be in that spot where you have enough scale to basically access the capital markets and do some interesting things, and Strive has clearly proven that they can, right? But you're not so big that you've sort of plateaued the growth curve, right? So we think that Strive is very much in that sweet spot. There are other companies as well, but Strive is perhaps, the best example of that. Certainly, they're the best example of that within the US market.
Yeah. You hit on earlier that, is there potential rotation from, between STRC and SATA, Strive's digital credit product? Obviously, STRC is an order of magnitude larger in size than SATA as well. So, I have to question how much rotation has been happening. It's, I suppose, impossible to know. But is there a statement, I guess, that as SATA's been trading more consistently closer to par. It hasn't run up to par, but what is, I guess, trading at 97, 98, $99 over the last month, mostly saying about the credit quality of SATA? Does the market value a cleaner balance sheet, so to speak, with less traditional leverage like converts or other loans on the books, Lance?
I'd be careful about drawing too many of those conclusions. And
Hmm.
again, look, I like both companies. I think they're both doing great work, and I think that they are um, they're symbiotic. I don't think that the success of one comes at the expense of the other. This is not a zero-sum game, in my opinion, right? But that being said, I would just say that you have to be careful when you draw those conclusions, I think, because you have to ask yourself, how deep is this market? And I think you alluded to that, Tyler, right? I mean, it's like, I don't know. I think at some point, sure, if we go back to our credit 101, right, we would say, okay, this company, their yield is tightening. So therefore, that would suggest that credit investors are viewing the risk as having receded relative to the company whose credit spreads are expanding. But again, I think that when you think about the size of these markets, the size of the money flows, the access to leverage, the ability to get borrow and therefore short, one versus the other, I think there are a lot of factors. So I'm not saying that any conclusion that you or anyone else is drawing is wrong. I'm just saying I'm not convinced that we have enough real data to really be able to say. But again, I don't want to miss the forest for the trees. I think the key point here is that a second preferred in the market changes the conversation. The first security proves an issuer can create something novel. The second security begins to test whether the market wants a category.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC-regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-treasury to connect with their team.
You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
That makes a lot of sense. Another thing that Matt Cole mentioned when I chatted with him recently was they saw a large short interest on their digital credit product. The borrow rate was sky high, like 30-40% borrow rate on a big short position. And the team's response at Strive to that was to say, oh, hey, we're gonna let this product run above par sometimes, maybe, tactically, or when it makes sense, or when they see that there may be some short action against their product. Do you think that's a I guess a move maybe that strategy can learn from, and what's your takeaway from how well that tactic might work?
I wouldn't want to I don't know that that's an area where I have specific expertise. What I would say is I've been very impressed by Matt and his team's ability to use the capital markets to their advantage. I've obviously been very impressed with not just Michael Saylor, but Fong Lee, Andrew Kang, his entire team. They're really top notch. I think all of these guys, and again, that's something that really matters, right? It's easy to launch a public Bitcoin treasury company, right? It's not easy to effectively manage one and be able to reliably and repeatably generate positive Bitcoin yield, right? And both of these companies have been able to do that. So if Matt is telling you that he's found something that works for him or that he thinks is going to, I'd be inclined to, I don't want to say give him the benefit of the doubt, but I think he probably has good reason for thinking that. Now, whether that would apply to strategy, it's not that simple. I think that, like, for example, a lot of people ask me, well, is strategy going to go to a daily dividend with Stretch? And I don't think that they are. I don't think, I mean, they might, and I don't have any special inside info on this, but when we've talked to them about this, they've kind of pointed out, and I agree with this, right, that, they're different companies. And ultimately, while they are similar in some respects, but they do have different parameters. They do have, different, constituencies. And so what works for one, the best course of action for Strive isn't necessarily the best course of action for strategy. They can both be doing slightly different things and both be making the right decisions for their constituents.
Yeah. I think strategy is also in this like position where they can kind of, because of their size and scale and kind of dominance in market share in the space, they can sit back and kind of learn and see what works from some of these smaller companies that are trying new things. When you think about these teams, like you mentioned, a bunch of the names, Andrew Fong, in addition to Michael Saylor at Strategy, Matt and his team at Strive, is there something is there something special in these teams that you can identify or put a name to that makes them well suited to run this strategy?
I don't think it's that complicated. I mean, it's not easy, but it's not complicated. It's you have to have good capital markets acumen. I think, Matt comes from a world of credit. He was running a portfolio at CalPERS for many years. So it's kind of in his DNA, I think, at this point. And, Andrew Kang similarly, has a deep background in capital market, as do, Michael Saylor, obviously. But so I think I don't think that it's anything magical. I think it's just that, have you spent, the 10,000 hours in this field, working with these instruments or working with these institutions and these types of investors?
Yeah, yeah. That's a good way to frame it, Lance. I think the special thing uh, that's just differentiated these teams is they spent the 10,000 hours in capital markets. They've also spent the 10,000 hours in Bitcoin.
Well, that's a good point, and I'm sorry if I just Tyler, if I could jump back in, because the Bitcoin point that you just made is really important, because right, and we've already seen this, right? How many of these Bitcoin treasuries have basically changed, their decisions? They're like, oh, Bitcoin isn't going to go up every day from now until the end of time. I'm out. Like, oh, I'm changing my strategy. I want to go buy a miner, or I want to buy a healthcare company, or I want to buy some real estate, buy some parking lots. I mean, it's crazy, right? But so what I want is the guy that's basically going to say, "Oh, Bitcoin is down. Okay, let's think about how we can maximize. We know that Bitcoin someday is going to be higher. We don't know when. We don't know how long. We don't know where it's going to go. We have to be very cognizant of the stress testing. We have to make sure that all our constituents, all our stakeholders are comfortable while we think about ways that we can take advantage and grow Bitcoin per share responsibly over time." You can't do that, in my opinion, without a really deep-seated conviction, and not just conviction that it's all going to work out someday, but a deep-seated understanding in the inherent volatility and the history and the patterns behind Bitcoin.
Hmm. Yeah, great points. Um, looking backward a little bit, Strategy's inclusion in the Nasdaq 100, was I think a real pivotal moment and a forward looking, and then a post after their inclusion were it was a big catalyst for the price rise in the run up in their stock at the end of 2024. You had a lot of factors, a lot of the Bitcoin halving had recently happened. You had a political environment where regulation was looking better on the capital markets front, on the Bitcoin front. Looking forward at a similar catalyst, so S&P 500 inclusion is I think a future catalyst that we can explore and look at, and I'm sure as part of your analysis, Lance. What's the importance of that, and I think more importantly, what's the realistic path that strategy takes to get there? Because on terms of, market cap and all the qualifications, certainly in a Bitcoin bear market, they're going to have negative earnings because they have to mark down their balance sheet. But when Bitcoin's price runs up the next time, as many of us expect, they'll probably check all of the boxes for index inclusion in the S&P 500. So what is the path there, and do you think it's likely?
So let me start by saying that, as a former distressed debt investor, right? I have a view of rating agencies, and S&P 500. S&P is a rating agency that, runs these indexes as well. And, the joke in distressed credit was always that the rating agencies are the last to know, right? If you're waiting for, so in other words, if you're going to look to S&P to tell you to get out of a bond, it's too late because the bonds can be trading at 40 before they go to default or whatever. And I think unfortunately the same thing is true here. They're not going to be, if you think that like S&P inclusion, S&P 500 that's going to be the catalyst that gets strategy working again. I don't think so. It's the other way around. S&P is not going to include strategy in the index until the debate has been settled and that everyone is, of the opinion that of course they'll be the last to know, right? So now that being said, let me just go back a little bit because I do think that this is really important. And I do think it's worth discussing, even in the context of what I've just said. So NASDAQ 100 inclusion mattered not merely because of mechanical buying or index flows. It mattered because it was another step in the institutionalization of the strategy story, right? It helped. So unlike what happens when we get into the S&P 500, this actually getting into the NASDAQ actually did help move the company from a niche Bitcoin linked equity into a name that large pools of public market capital had to understand. S&P 500 consideration would be another step in that process, but I don't think that it certainly isn't automatic. And, I guess my answer would be, while S&P 500 would matter even more symbolically, I don't think it's something that we shouldn't be expecting to see that, in the near term. What can strategy do to sort of, to kind of move in that direction? Continue doing what they're doing. You know, I think there isn't a silver bullet that they can, if they do this tomorrow, they're in September. I think it's going to take time. I think it's going to take surviving multiple cycles. I think it's going to take further adoption of Bitcoin as digital credit, as digital capital, as digital credit and digital capital. I think of it as more of an evolution than a moment in time. Look, I hope I'm wrong, and but I've been very careful when I've talked about S&P 500 inclusion in my published research to talk about it as, of course, yes, it would be a positive catalyst, but we've never underwritten our thesis around that component.
Yeah, makes a lot of sense. It's a really measured approach, and I think a practical one. Covering the space, I think I'm filled with hopium sometimes, of inclusion being right around the corner. But will certainly be something to monitor, and excited to see how that plays out. This has been great, Lance. Before you go, just real quickly, can we do one for fun for the audience? And can you give me a name in your book, maybe a story that you love, someone you've covered? I know you've covered Opera, DraftKings, Caesars. Maybe there's another one in your sleeve of companies that you've done research on that had a really cool story.
Well, sure. I mean, look, and I'm tempted, of course, to go back to Strive, but I'm guessing that you want something to change up from the Bitcoin treasury.
Yeah,
So
yeah. Let's go off brand.
understood. So let's talk about Opera. And Opera, I'm not sure if you're even familiar with them, but it's a very different story. It's definitely not a Bitcoin treasury company. It's not a digital asset company in the way we've been discussing today, although there is some adjacency. But most investors, if they think anything at all when they hear Opera, they think browser company, right? Opera makes a niche web browser, and it also has a increasingly valuable ad tech platform. And what we've seen over, the last, few years is that the company has been growing its revenue organically north of 20% year in and year out for the past 5 years, really, since I've been covering it. They generate substantial free cash flow. They have no debt. They're buying back stock. They pay a big dividend, and they're trading at what would be considered a relatively modest valuation multiple for that growth profile. They trade at like 7 or 8 times cash flow. So for growing, 20% on the top line, and obviously there's operating leverage in the business, so the cash flow is growing even more quickly. But the part that I find especially interesting is that their business model is becoming more valuable as internet activity increases, but they aren't spending, unlike all the other companies that you're reading about, they aren't spending billions of dollars trying to win an AI arms race, right? In fact, there is really virtually no capex in this model. And so in our work, we describe Opera as sitting above the model layer rather than competing inside it. They benefit from AI adoption without having to fund the massive compute infrastructure or train frontier models themselves. So instead of asking which AI model wins, they're effectively asking, how do we increase engagement and monetization regardless of which model wins? And that's a very attractive position to be in. And, I just to sort of quickly tick through, a couple of things here, the revenue, as I mentioned, has been growing quite strongly. Their user growth in the US has been very strong. There's some interesting optionality from some self-funded ventures. They own a company that they incubated themselves called MiniPay, which is still relatively small and quite frankly may not come to much at the end of the day, but I believe we have a free option on it as shareholders. MiniPay focuses on digital payment. Basically, it's like Venmo on the blockchain, or some people call it Venmo, global Venmo. It is, it's not really all that practical in the US where we have access to Venmo, but of course you can't use Venmo to send money to, to Africa or to India or Pakistan, right? So management has already kind of built this into a business that has 18 million users. That's up 2 million from where they were at the end of June. So, the pretty rapid growth. And the company is, as I mentioned, is extremely cash flow generative. And we think that there's very likely, in addition to the stated dividend, we think that there's a good chance, if you look at their cash flow profile, that they're going to buy back. They have a share repurchase program in place, $300 million, over the next 2 years, for a company with a total market cap of, not that much more than I think it's about 1.3 billion right now. So we think that this could be a big one. And I guess, again, just referring to our published numbers, we have a $33 price target on the stock. I think it's trading at 19 the last I looked. So we like that one quite a bit.
That's cool. That sounds like a really interesting potential growth story, and I'm especially interested about kind of that free option on the mini pay. Is it
Mhm.
is it called? Yeah, yeah. And that one hits. I remember sitting around as a kid 20 years ago using Opera. They always had the coolest new features, and we're rolling out features. So it's cool to hear that they're still innovating and doing different things today, Lance. Well, this has been a treat. Thank you so much for talking shop. Like I said, you were largely requested by our audience, so it was great to finally catch up with you and talk strategy, talk digital credit, and everything there. Where can people follow you and your research?
Well, that's a good point. We at TD Cowen, right? So we are strictly institutional. So we don't have a retail outlet, which means unfortunately that it's not easy for most folks to follow us. My sense is that our research kind of gets out there. I have to be a little bit careful about what I, say or do, but quite frankly, I feel like these the Tyler, thank you so much for hosting me. These types of opportunities are I think always so interesting for me, just to be part of the dialogue and to hear what other people are thinking. Again, recognizing that like not only am I not the first guy in, I'm like one of the last guys in. I think I'm a fast learner, but I've only been doing this for the past few years. And so I'm grateful to be here. Thanks so much for having me.
Yeah, great stuff, Lance. And your voice has been a welcome addition to the community and one that's, I think, well respected. One thing I have all my guests say before they leave is in a nod to Bitcoin is stay orange.
Thanks. I will.
Great. Take care.
Bye.